part of the reason there are going to be plenty of opportunities is other people doing dumb things.
This year, stock market investors are going to face three really big challenges unique to 2025. Reasonably high interest rates, overvalued stock prices, and the ongoing effects of rampant speculation in the markets. Now, all of these make investing pretty tough right now, but luckily for us, the world's best investor, Mr. Warren Buffett, has spoken extensively on each of these topics across the last year or two. So in this video, I want to turn to one of the brightest investing minds on the planet today to understand how we should be going about our investing in 2025. Now, the first issue that really heavily impacts investors today is interest rates. And for the first time in a long time, I'm talking a good couple of decades, investors are dealing with much higher interest rates to what they're used to. In America, the Federal Reserve, basically since the global financial crisis, has kept interest rates at almost zero. But as we know, thanks to the hefty post-COVID inflation, rates were hiked from 0 to around 5.5%. Now, we have seen 3 rate cuts so far, bringing the Fed funds rate down to around 4.5%, but that's still a lot higher than what's been observed for much of the last couple of decades. And why is this important? It's because interest rates directly impact treasury bonds, and treasuries kind of act as the yardstick to which all investment opportunities are valued.
Interest rates, basically are to the value of assets what gravity is to matter. I mean, if I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping.
How does this work? Well, as interest rates rise, the return you get from new government bonds rises, and as they fall, then naturally the return you get from treasuries falls. Now, treasury bills are deemed incredibly safe in the investment community, and what this means is that when interest rates are hiked, more of the big money is inclined to take their money out of stocks and keep it locked in safe short-term treasury bonds, which right now is a reasonably good deal with a yield of 4.3%. It's nothing amazing, but it's good for such little risk. But what that means generally is that because so much money is returning to the safe haven of bonds, when interest rates are high, it can be a lousy time for investors who like to keep lots of their money in stocks. The big money tends to favor bonds, and high interest rates also makes it tougher for businesses to get financing to grow. And for companies holding a lot of debt, when that debt is rolled over, it also takes more money out of their pocket to service the debt. High interest rates make times harder for businesses. And one common concern amongst stock investors heading into 2025 is the idea that if inflationary forces persist, such as global conflicts, tariffs, geopolitical tensions, increased militarization, ongoing government spending, well, it's not too out of the realm of possibility for interest rates to stay at these elevated levels for a long period of time, which may put businesses under the pump. Now, this is a very interesting discussion topic because so far these tougher economic conditions actually have not led to a huge tightening of stock market valuations, and actually the S&P 500, the 500 largest stocks in America, collectively rose 23% in 2024 on the back of a 24% rise in 2023. And yes, we are going to discuss that in a little bit, but there's still some concern out there of sticky inflation putting pressure on the Fed to keep rates high for longer, which should put pressure on business performance. So with that hypothesis in mind, what is Warren Buffett doing about it? That's what we're going to talk through next. But before we do, I want to talk you through a problem that a lot of us are facing today, which is spam. Your phone, I get those infuriating scam texts all the time. Your email, actually my spam problem got so bad for my old email address, I had to completely abandon it and just start a new one. I'm not even joking. And the reason why we all get so much spam these days is because scammers can buy your information. So data brokers, they know your name, they know your number, they know where you live, and then they will sell this information to the highest bidder. And it happens more frequently than you think. Just recently, BT Group in the UK, formerly British Telecom, confirmed that its BT conferencing business division shut down some of its servers following a ransomware breach, leaving a lot of people exposed. This stuff literally happens all the time, even if you're protective of your data. But that's where today's video sponsor, Incogni, can help out. Because what they do is they reach out to data brokers on your behalf and they get you taken off these lists. So all you have to do is sign up for Incogni, you give them permission to act on your behalf, and then they go out and find what lists you're on and demand that you be taken off. Plus, they also make sure your data stays off of the market by conducting repeated removals, taking your data down if it somehow pops up again. That's why I'm on the yearly subscription now. And if you'd be interested in trying this service out for yourself and getting your data out of data brokers' hands, you can sign up using the link in the description and pinned comment. And by using the referral code NEWMONEY, you can score 60% off an annual plan. So thanks to Incogni for sponsoring this video. And now back to Buffett. And as I was saying, there is still the concern out there of persistent inflation, which will keep rates high for longer. But then what is Warren Buffett doing about it? Well, the truth is, he's actually selling some of his share portfolio, namely his monster Apple position, to specifically put more money into bonds.
But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive.
And in reality, that cash he talks about is actually held in treasury bonds. So when he says he doesn't mind building the cash position, he really means building the pile of short-term US treasuries. As you can see, in the most recent quarter versus the same quarter 12 months ago, it actually has Berkshire's cash position reasonably even. But as you can see, Buffett has reduced the stock portfolio and sits that extra cash in short-term US treasuries that have grown quite substantially. So that's really the first thing we can take away from Buffett's actions over the past 12 months. In these higher interest rate environments, when things seem reasonably shaky around the world and uncertainty rules the day, don't forget about bonds.
We've had 125 billion or so in very short-term investments, and believe it or not that long ago, we were getting 4 basis points, which is next to nothing on that 125 billion, which means we were getting 50 million a year. And now the same money the other day or day before yesterday, we actually bought 3 billion of bills at a 5.92 bond equivalent yield. So we will have what produced us not that long ago on a 12-month basis was producing 50 million a year, producing something in the area of 5 billion a year. So
sure, they're nothing spectacular, they're not flashy or interesting, but they do serve a purpose, particularly when everywhere you look, valuations on any sort of decent businesses just sit at sky-high levels. And that actually leads us straight into the second big problem investors face in 2025, and that is lack of opportunities. I mean, Warren Buffett has been very vocal about this over the past year or two because it really isn't making a whole lot of sense. You know, interest rates are higher, but most big American companies are not struggling with their valuations. In fact, despite the high interest rates, valuations of American businesses are soaring. And it's particularly evident in these so-called Magnificent Seven companies: Amazon, Apple, Microsoft, Tesla, Google, Meta, and of course, Nvidia, as investors bid these prices up, believing these 7 companies will be the main beneficiaries of AI adoption moving forward. But the problem is, this overvaluation in the market is leaving investors with very little to nibble on at anything close to a reasonable price. In a recent shareholder letter, Buffett said, "In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects." And this is what Buffett had to say about the state of the market, most recently at last year's shareholder meeting.
You're sitting on 168 billion of cash. 1, what is Buffett waiting for? And 2, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it now at 5.4%, but we wouldn't use it if it was at 1%.
That last sentence referring to the fact that even if Buffett wasn't earning decent amounts from his cash by parking it in treasury bonds, he probably still wouldn't deploy it in the stock market at current valuations. And while the job is a lot harder for Buffett to find companies to invest in, as these investments need to move the needle for Berkshire, which is very, very hard to do, the problem is still very much there for most investors looking to invest in decently sized companies, particularly in America. Any company showing decent signs of growth is rarely at a PE multiple below 25 or 30, which is making things very tough at this current point in time.
This is not a time when the phone is going to be ringing often, but there have been times in my life that I've been awash in so many opportunities that I could have invested everything by nightfall. And then there's other times when the year goes, well, not in the early days, but now we haven't seen anything that makes sense, that moves the needle. We only swing at pitches we like. And it's just that things aren't attractive. And well, there are certain ways that can change, and we'll see whether they do.
And that leads us to the question, well, what do you do about it? And well, by looking at what Buffett is doing, there are really 2 answers. The boring one is that you don't really do anything. You build up the cash pile for a rainy day, maybe look at avenues where you can minimize the impact of inflation, such as treasury bonds, and just stay patient while you keep searching for those hidden opportunities. Or the other option is to broaden your horizons. Look in the less analyzed markets, which is exactly something that Buffett did a few years back when he made a sizable diversified investment in 5 Japanese trading houses.
I was looking at company after company, as I'll do every day, and I just thought these were big companies. They were companies that I generally understood what they did, and they were selling at what I thought was a ridiculous price, particularly the price compared to the interest rates prevailing at that time.
So by looking to other markets that aren't the US, you can actually find cheap businesses. And that was one of the ways Buffett was able to find a big multi-billion-dollar investment just a few years ago. You know, he's doing it, Monish Pabrai is doing it, Howard Marks, Guy Spear, Charlie Munger was doing it before he passed away. And it's a strategy I've started to adopt as well. You know, at the end of last year, I was in Turkey with Matt Peterson, scoping out big notable Turkish businesses with super low single-digit P ratios like Coca-Cola and Toothbrush to see if there might be something worthwhile there. The only thing to note here, though, is to make sure you're staying firmly within your own circle of competence if you do go down this route. The first rule is to make sure you don't go messing around in areas that you don't understand. But with that said, that's what Buffett is doing about the overvaluation and the lack of opportunities in the market at the moment. And the last investing theme of 2025 that I wanted to cover in this video, which is closely related to the overvaluation we're seeing, is the temptation to speculate. You know, in 2024, it's no secret, we saw greed and hype absolutely take over. Share prices exploded a long way away from business performance. Speculative assets like Bitcoin rose over 100%. And this momentum seems like it'll probably continue into 2025. And in these environments, particularly for newer investors, it can trigger just a tremendous amount of FOMO, so fear of missing out. And ultimately, if you're not super on top of your emotions, it can encourage you to start speculating in high-flying, expensive stocks, as opposed to making rational long-term investments.
Well, the stock market, we've had a lot of people into the casino in the last year. You have millions and billions of people have set up accounts where they day trade, where they're selling puts and calls, where they, I would say that you had the greatest increase in the number of gamblers, essentially, and conditions lead to this place where more people are entering the casino than are leaving every day, and it creates its own reality for a while, and nobody tells you when the clock's going to strike 12 and it all turns to pumpkins and mice. But this is about as extreme as we've seen it, isn't it, Charlie?
And Buffett is right. When everybody is speculating, it does kind of create its own reality for a while. People speculate and that drives up stock prices, which encourages more people to speculate and prices surge higher again. And sure, maybe this can make you some money in the short run, you know, as we've seen recently, but over an investing career, it's one of the most dangerous behaviors you can fall into, because if you're constantly treating the stock market like a casino, you know, it's only a matter of time before you get wiped out when things come back to reality, which eventually they always do. So the challenge in 2025 is to train yourself to avoid speculation, as Buffett has done over his whole career. And one other point I wanted to bring up is to remember that the increased speculation in the market right now might seem annoying for long-term investors because everything is just so high, but it's actually not such a bad thing for long-term rational investors like Warren Buffett, because it's the increased levels of speculation and trading in the market today that move the market much more rapidly than ever before. And the market, as we know, can swing rapidly in both directions.
I would argue that there's going to be plenty of opportunities, and part of the reason there are going to be plenty of opportunities, the tech doesn't make any difference or any of that. New things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things. And, well, the 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things. I think if you don't run too much money, which we do, but if you're running small amounts of money, I think the opportunities will be greater.
And the reason they'll be greater if you're running a small portfolio like what we all do is because when something goes bang and the speculators turn from greed to fear, sending stock prices, you know, through the floor, then you can immediately jump in and take advantage. Because while right now speculators are causing many stocks to skyrocket, things can go the other way equally as quickly. And that's what Buffett is talking about here.
If you look at stocks as a business and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time than if you try to take charts and listen to people talk about moving averages and look at the Fed pronouncements and all of that sort of thing. And
speculators let the market instruct them, whereas long-term investors let the market serve them. And that's a really important distinction to make. The best investors like Warren don't feel the need to be doing anything in particular at any moment in time. Right now, with everything so high, he isn't feeling the pressure to get his billions in somehow. In fact, he's letting the market serve him, and he's actually taking the opportunity to take profits, namely in Apple, at such high valuations. Then when prices are super low, say after the 2008 global financial crisis, for example, Warren again let the market serve him, but this time the market gave him many companies at extremely low valuations, so he took up the opportunity to buy. He bought Bank of America, he bought Goldman Sachs, GE, even BNSF, all which turned out to be extremely profitable investments. So I think that's really it. In summary, yes, this year we will be battling in a market that's dealing with higher interest rates. Unfortunately, we're also going to be battling a lack of opportunities thanks to the crazy hype and speculation in many of America's large companies, but we need not panic or feel pressure to do something that doesn't look great on paper. Remember Buffett's punch card analogy. In your investing career, imagine every time you buy a stock, you have to punch a hole in the card, and that card only has 20 punches in total. Then you're done. Long-term investing isn't a game where you're likely making 5 or 10 investments a year. Rather, it's a game of staying patient and investing in those smack bang home run opportunities that do come around very infrequently. Or if you're not the type of investor to take an interest in stock analysis, then the game is simply about market-wide diversification and dollar cost averaging through thick and thin. That's the other thing that Buffett promotes. And honestly, that's really all there is to it, those two strategies. Finally, I do just want to say that if you're interested in learning the full Warren Buffett approach and you want a step-by-step walkthrough of the entire stock analysis process, you can check out Introduction to Stock Analysis, which is a 7-hour professional video course I've created with my team. That is linked down in the description below. But apart from that, thank you guys very much for watching, and I'll see you all in the next video.